Well, hello, everyone. My name is Carolina Huaranca Mendoza, and I am a scout for Lightspeed Venture Partners, but also your moderator for today. And thank you to the Peruvian Venture Capital Conference. This is our a seminal panel that we're having on the value of investing in underrepresented fund managers. So super excited to have all our panelists here today and our audience to join us. But before we kick it off, I want to just share a few quick personal notes to set a context of this panel, specifically context of what's going on in the actual, in Peru, but in the region, in LATAM as well. So on a very personal note, this panel means a lot to me as a child of immigrants, of Peruvian immigrants who left Arequipa, who left Lima to seek a better life for their kids decades ago during a very turbulent time in Peru. And now it's our 200-year anniversary of independence. But I would be remiss by not sharing that there are challenges in the country. We have left pinned against right and a lot of wealth inequality, and that's factoring also the pandemic. So I wanted to share that context because the conversation we're going to have has a theme around underrepresented fund managers, but also diversity and inclusion. And with the fact that in a region and in a country where there's wealth concentrated in very few folks and the rest don't have as much access, I think to put it in tech ecosystem context building, it's important to ask ourselves who isn't getting funded and who is getting funded, both on the entrepreneurial side, but also on the fund manager side. So I know that today we'll have a conversation that will hopefully push the narrative for people who are GPs, angels, as well as LP investors to think that amongst themselves as they start making investments. So thank you for giving me that time to share that little context. And now we'll start with our panel and our esteemed guest. So for our three panelists, I'd love you, one, to share your name, two, the firm and a little description on the firm you work with, as well as your function there. So why don't we kick it off with Lo first?
Sure. Well, first, thanks for having me. Lo Tony, I'm the founding managing partner of Plexo Capital. We are an institutional investor allocating capital both as an LP, limited partner, an investor in venture funds, as well as investing directly into companies that we source from the portfolios of the Plexo Capital GP network.
Great. And now we'll turn it to Jasmine.
Hi. Yeah, thank you so much for being here. It's great to be able to speak on this topic. I'm Jasmine Richards. I'm at Cambridge Associates. We are a global investment manager. Our clients are span the gamut of large corporate and public pensions to high net worth individuals. But the bread and butter of our business is endowments and foundations. And we build portfolios on behalf of those clients. My role specifically is investing in diverse fund managers, currently defining that along ethnicity and gender lines. And so I get to go out and find new talent that, again, has been historically underrepresented in the industry.
Great. Thank you so much for that, Jasmine. And last but not least, Betsy.
My name is Betsy Zimmerman. Thank you so much for having me and spotlighting our firm. I'm a founding managing partner of First Close Partners, and like Lo and Jasmine, we aim to increase diversity in venture capital by investing exclusively in underrepresented managers. We called ourselves First Close because we're very comfortable being the first or one of the first institutional LPs to commit to a fund. Indeed, we welcome it, and we believe that our early commitment amplifies signal and dollars in real and significant ways for the funds that we invest in.
Great. Thank you so much for those introductions, everybody. Now, the theme of this panel is underrepresented fund managers. But what does that actually mean in terms of your specific mandates? And I think sometimes the use of that word can mean very different, or term, can mean very different things if you're in the US versus being in Asia or MENA or LATAM. So I'd love to get first Lo's perspective on it and then the rest of the panel.
Thanks. I think For us, what it means is thinking about underrepresentation based on the demographics within the market where the LP commitment is being made. So for example, in the United States, we look at the demographics of the United States and see how well that maps to the demographics of by ethnicity and gender for us to the overall venture capital industry. And so when we make an LP commitment, we have this thesis around the unique networks that women and people of color bring to the table. And so those are very important to us. Now, let's talk a little bit about what we do outside of the United States, because that's a question that we frequently hear. We invest globally and have made LP commitments in Canada, in Latin America, Mexico, and then also on the continent of Africa in Nigeria. So typically we do a couple of things. Number one, we do look at the demographics within that local regional market. And often what ends up happening is gender becomes the obvious way to be able to make our model work. Or we look at the location of one of the GPs. So for example, we're an LP in a company, a firm called Investo in their fund. They're based in Mexico City. And the two GPs basically travel so frequently in a pre-pandemic world back and forth between the United States and Mexico that we applied some of the same statistics for the GPs in the United States, just given how frequently they travel back and forth. So that's a little bit about how we think about it. You know, I think we track over, at this point, we're tracking over 1,100 firms, and we've touched about 400. And so what we've seen in our database is that about 40% of the GPs are female, 68% are people of color, 46% are underrepresented minorities, and about 17 are underrepresented minority females. So a little bit about how we think about the world.
Wow, that is, I had no idea that there was so much out there, and that you are also investing so globally, Lo. So thanks for sharing that context. Sure. I'd love to also get the perspective from each of the other panelists and reactions to what Lo shared. Betsy, why don't you share a little bit of how First Close Partners sees underrepresented fund managers?
So we have a lot of overlap with Lo, and in fact, we're in some of the same funds together, which we're very happy about. We invest in funds all over the world, but like Lo, we're based in the United States, and of course, that lens informs our definition of what underrepresented is. In the US, as in much of the rest of the world, straight white men dominate VC, both in terms of dollars and headcount. So for us, underrepresented means women, Black and Brown and Asian and Latinx managers. It also, though, means that we specifically look to include managers who are LGBTQ or who self-identify as persons with disabilities. That's another group that doesn't get a whole lot of thought in venture. It's not well represented, and we're really pleased that we have a couple of funds now with GPs who self-identify as persons with disabilities.
Got it. And at Cambridge, Jasmine, how do you answer that question for underrepresented fund managers?
So our definition is largely informed by how we construct our portfolios and how we work with clients. So at Cambridge, one of the hallmarks of our practice is that all of the portfolios we build for our clients are bespoke to those individual clients, as well as we're investing with clients across the globe. And so what that first means is we absolutely will incorporate the regionally contextual definitions that both Lo and Betsy touched on. Who is underrepresented in Australia is not the same as the populations that are underrepresented in Europe or in the US. And so we want to be mindful of that. What we also think about, and we spend a lot of time with clients on, is what are your goals? Because we think what your goals are informs how you're defining this. And so for some clients, they do want to focus on ownership and who's controlling the firm. What we think is also worth incorporating is we know that underrepresented, that for founders, there are several populations that are also underrepresented. It tells with some of your introductory comments about Peru specifically, who was getting funded. And so for some of our clients, their goals are impact in ensuring equity in terms of access to capital. And so if that's your goal, then in some ways, the point isn't who owns the fund or who the GPs are. You maybe want to measure who are they investing in and what populations are being impacted. And then we also will look at what founders are, what companies they're investing in, and what communities those populations are impacting. If this is a healthcare venture fund that is specifically investing around increasing equity and access to healthcare, I would argue that regardless of who is running that fund, it will align with some of the goals for our clients in terms of increasing access to capital and underrepresentation. And so I think we do, because of the way we build portfolios, have a very expansive definition.
So my takeaway from what you all are sharing is context matters, right? Especially if you're investing globally, context matters. But there is, I think when people are investing globally, there is this immediate gender conversation that starts, like that becomes like the go-to de facto, but there's much more nuance to that once you actually start investing in particular regions. And that the US seems to have a lot of conversations around race and ethnicity, whereas I think in Latin America, folks are starting to have these conversations. I would say many people are like, everyone's Peruvian, but in the reality, I wouldn't define myself. I would say I'm an indigenous Peruvian, right? And I think younger generations are starting to identify more like what I'm seeing the US categorize on the census. So with that said, Jasmine, I wanna double click on that there's a difference here that both Betsy and Lo are managing fund of funds, but you're at Cambridge. So can you share a little bit more about Cambridge Associates? Because you mentioned clients, so I just want the audience to understand like your role from investing in fund managers.
Absolutely, no, and I appreciate you making that distinction. So I think of the difference as Lo or Betsy, they get to be LPs or limited partners in funds. In some ways, we have practices where we have discretion over the portfolios of our clients, but in essence, we are investing on behalf of those clients. And so each of our clients will be those limited partners, and we are their representative. We're doing the research on the funds. We get to evaluate fantastic managers like Lo and Betsy and find clients where we feel like these investments meet their goals. And so while we in some ways see many of the same managers, and I will call Lo, Betsy, and you, Carolina, to discuss managers and check my own biases, the difference here is that we also can be an intermediary as well.
Got it. So what I thought was really interesting is that you mentioned checking your own biases. Even though this group is a very diverse group, the reality is everybody has biases in general. So I want to hone in so the audience also understands that we just in general, human beings have bias. But because we have two incredible fund of funds here, I wanted to also ask Lo first, what was the inspiration or what catalyzed you launching your own fund of funds? Because you've been an operator, you've been a VC at multiple funds. What inspired that, and what did you see that others didn't so you could launch Plexo?
Sure. I think the first thing I will, as Jasmine did, and kind of highlight in the fact that there's a distinction with Cambridge Associates, I'll highlight that there's actually a distinction with Plexo Capital, and it may just more or less be the way that I think about the world, but I never think of us as a fund of funds. I don't call us a fund of funds. We're not, by SEC definition, a venture capital fund, since more than 20% of our dollars go into, don't go into direct opportunities, and we've now surpassed that $150 million threshold as well that provides an exemption. So I don't think of us or call us a fund of funds unless it's required by the very narrow lens of the SEC. Here's why. When I think about the allocators of capital that invest across different opportunities, the full stack of opportunities, I think of Goldman Sachs, right? So no one would call Goldman Sachs a fund of funds, yet Goldman Sachs is an LP. Goldman Sachs isn't a venture capital fund, yet Goldman Sachs makes venture capital investments, right? So my preference in the way that I think about, and I'm extraordinarily ambitious, like off the scale. So I never want to place us in such a small box. Not that I would not mind having the AUM of Horsley Bridge, would love to do that. But I just think about the way that we're designing and architecting Plexo Capital. It's extremely far beyond when someone hears fund of funds, oh, I'm going to put them in this bucket. I don't want to be in that bucket because I have bigger aspirations. So that's where, now, I actually get so passionate about this that both I and likely the audience doesn't remember the question. So please give me the question again.
What is that? Okay, so now that I'm clear that that Low is not a fund of funds, thank you for that passionate comment. And the question, going back to the question, is that what inspired you to start your own firm to invest?
Okay, I'm actually passionate about this topic as well. Clearly not as passionate about the definition of Plexo Capital, but yes. So the origination story happened when I was a partner at GV, formerly known as Google Ventures. Larry and Sergey, we're going back to 2015. We're still Larry and Sergey, the founders of Google, right? Alphabet is the holding company of Google, and GV or Google Ventures is the early stage investing unit. Larry and Sergey wanted GV to deploy more capital. They were extremely happy and satisfied with the model and the results. We, as the partnership at GV, were thinking about different ways to access more deal flow to increase the size of the consideration set. We saw an opportunity with initially Black GPs and looking at their ability to, because of their unique path into venture, have access to these really interesting and unique networks that were driving differentiated deal flow. We thought that's pretty interesting. Upon further review, what we also noticed is that there was a different lens applied through Black GPs to be able to, number one, identify different market opportunities that others might miss on Sandhill Road in the absence of an abundance of data. So think about folks investing at pre-seed and seed. Typically, it requires some level of familiarity with the market to kind of really understand what the potential could be, as opposed to a later stage opportunity, think post-Series B, where there's enough financial data and key metrics that even if one didn't know anything about the industry, if you said, hey, Lo, here's a life sciences company, here's the financials, here's what good financials are, I'd say, oh, well, this is either a good opportunity or not a good opportunity. At the pre-seed and seed, that data typically doesn't exist. So if there's familiarity with the market, then that helps the entrepreneur with the fundraising process. And so what we saw was, hey, well, Black GPs, they have familiarity with some different markets that others might miss on Sandhill, as well as the ability to apply a different lens to the evaluation of the entrepreneurs themselves. Because as we all know, not every entrepreneur is going to look like Mark Zuckerberg as he did 15 years ago, right? Or maybe 20 years ago at this point. And so we thought that was interesting. And then really diving into the data and looking at some of the more mature companies in these Black GPs portfolio, we were like, wow, I actually could have seen these companies earlier and had a better opportunity to invest at a lower valuation. But now we're seeing those later, just kind of comparing the GV database of, hey, here's when we saw the company, here's when they invested. There's a little bit of alpha there. And so we ended up making 5 LP investments into seed stage funds led by Black GPs. I looked at that and I was like, wow, that's pretty interesting. I brought in a few of them. I brought in Base Ventures, Eric Moore, and Charles Hudson from Precursor. And I saw it working so well that in February of 2016, I said, hey, I think there's an opportunity to build a standalone model. And that was kind of the genesis of Plexo Capital. I explored it for 6 months, got the support of my former manager, David Crane, the CEO of GV, got support from the Alphabet leadership, and was able to transition into an entrepreneur in residence role. And my company was Plexo Capital. So I incubated it for a year and a half and then spun out in March of 2018 with Alphabet as our anchor, and then brought on Intel Capital, Cisco Investments, the Royal Bank of Canada, Hampton University, a historically Black college where I went to school, and also the Ford Foundation. And then I expanded it from Black GPs because I saw similarities between female GPs and other people of color. So that was really the inspiration. And look, I started this before the narrative is where it is today in the United States, post the murders of George Floyd, Breonna Taylor, countless others. So it was a little bit of a different conversation. Really the Me Too movement hadn't even gotten into full gear yet. So I was very focused when I was fundraising on Fund One around the business proposition, the ability to be able to take these unique insights, drive alpha, and generate superior returns. And then it was oh, by the way, I think this will also have a positive impact on increasing the diversity in the overall ecosystem. So I had to lead with the business case first. Whereas today, I think fortunately, we have the opportunity to have a more open and honest narrative in the aftermath of things like Me Too and George Floyd, Breonna Taylor, so that we can also talk directly about, well, hey, this is just something that also needs to be done. So I'm really happy that the narrative has changed, and I always say I welcome more people. If someone wants to copy our model, awesome. All that means is there's more dollars available, because by the way, there's actually a lot more to Plexo Capital, even though the headline is diversity, behind the scenes. So at a moment's notice, I would love to see our model go obsolete on the diversity front. Unfortunately, I don't think that's going to happen for several more funds.
Okay. Well, I want to stress the point that you made. There was a clear business case. There was unique insight that you saw that fund managers had that others didn't. I do want to double click on that piece though, Lo. Give me an example to contextualize for the audience. What unique insights did you see around maybe particular markets or GPs of deals that they saw than other folks? And
I'll give one of my favorite stories. This is one of my favorite stories. I'm sitting in a cafe in Oakland, California on Piedmont Avenue with Eric Moore from Base Ventures, who I brought into GV, and we made an LP investment. Eric, tell me your most interesting deal right now. Lo, my most interesting deal is this guy named Deshaun, who actually is from Oakland. I'm from Oakland. Who went to Hampton. I went to Hampton. And he started a company to sell hair extensions for Black women. I was like, what? That doesn't make any sense. And so Eric says, no, think about it. Think about the market size. Think about the fact that Black women spend 3x over index on beauty products as compared to other ethnicities. And think about the process to be able to buy hair. He created an app so that the stylist can actually, in the seat, provide the customer with an infinite supply and then actually be able to participate in the economics now. And I was like, oh, wow, that actually is kind of interesting. Now, you cannot script this unless if you're a Hollywood producer. 30 seconds after that, in walks Deshaun randomly. So I get to meet Deshaun, the entrepreneur, and built a relationship, invested personally. Ended up one day at the Battery Club, and actually it was a combination of Starbucks and then the Battery Club. We spent 3 hours where Deshaun told me his story about how he literally, people often misuse this term literally, but literally was laughed out of venture capitalist offices on Sand Hill Road. Okay, so he had to piece together his initial funding however he could. Lo and behold, here comes Ben Horowitz, whose wife is African-American. He understands that market really well. Then Ben said, hey, I want to invest in your company. Ben leads the run. Now, remember all those VCs that laughed him out of the office. Now they come back like lemmings. And Deshaun is like, well, wait a minute. You guys literally laughed me out of the office. They were like, yes, but we never said no. So I think, that to me really just speaks to, Eric Moore saw it because he had familiarity with the market, right? So I think that's what we mean when we say, Eric was able to get to Deshaun. Eric had the unique lens to understand the market opportunity. And Eric looked at Deshaun, and even though, Deshaun didn't look like Zuck 20 years ago, he said, well, this is a person that can actually execute on.
Yeah.
So there you go.
That's an amazing story. And Ben Horowitz, as a reminder, everyone, one of the GPs of Andreessen Horowitz, right? And now the fund, Deshaun has gone, past a Series B now?
That's correct.
Right. So, this is a perfect example. So I want to really stress that point. underrepresented fund manager saw these unique market opportunities that others didn't way earlier, and you can make significant returns on those opportunities. So Betsy, now going to you, kind of share a little bit about the catalyst story for First Close.
Hold on one, sorry. It took me a second to unmute there.
That's okay.
Yeah, so like Lo, my husband Ed and I have been adjacent to or in venture for a long time. And we've known each other since we were 17, 18 years old, and we've always been politically aligned, as well as aligned in lots of other ways that we look at the world. So as venture investors, through our family office, we've invested in over 100 funds and over 150 startups. And starting in about 2012, we began investing with intentionality and also writing about the gender gap in venture and the racial gap in venture. And Ed, in his professional life, started seeking out and creating opportunities to introduce LPs to founders of color, women founders, female GPs, GPs who are people of color. And we invested in their funds. There were not very many funds, especially in those early years, and there aren't nearly as many as there should be now. What we found when we co-authored articles or case studies about it is people in venture could relate to what we were saying about the struggles for women in this space. They really didn't get it or care, or maybe they just couldn't relate to what we were saying about the problem with the whiteness of venture until the tragic events of George Floyd's murder and the terrible, terrible other murders and tragedies that have occurred in the last several years. And, as Lo referred to, suddenly institutional managers in venture and venture firms themselves woke up to the fact that maybe this was something that they should care about. And they knew that we had a network of people that we had been working with alongside and investing into for many years, and started to ask us for intros, which we were thrilled about. And that's something that we'd always been looking to do, and we'd made many, many introductions. What we found with an increasing level of frustration, though, was we would make an intro for an incredible fund manager, and some of the people that Lo mentioned are people that we've invested in from Fund One. There are lots of other managers as well. So people like Maya Famodu at Ingressive, or the folks at Base, or Sarah Kunst at Clio Capital, or Monique Woodard at Cake. These are all incredibly talented managers that we have the highest level of respect for. We would make intros to LPs that we knew well. And those LPs would by and large say, thanks so much for the intro, which I asked for. I'm delighted to meet this person, but I can't invest. And some of those reasons were structural. Either the funds were too small, or the fund managers were a little bit too early in their trajectory. One of the not so hidden secrets in venture capital is that institutional investors, by and large, are extremely conservative. They are not interested in making a bet on an unproven Fund One, even for a manager who has an extensive track record, because it could literally cost them their job. And there just isn't upside for them in making that decision, making that recommendation. Other times, the funds that these folks were raising were quite small, because it's not so easy when you're a person of color or when you're a woman to raise a $100 million fund. So very often these are micro funds, $2 million, $5 million, $10 million. And institutional investors can't write checks into those funds because the funds themselves are just too small. They can't be such a large percentage of the fund, and their minimum check size is often $5, $10, $20 million. So, we found ourselves increasingly frustrated that we were making these really high quality introductions to terrific managers, and they were not walking away with checks. And we wrote about it, and we talked to other friends in venture about it. And over Thanksgiving weekend last year, we actually were on the phone with our dear friend Teresa Gao of Acrew Capital, formerly of Accel. And Ed and I said kiddingly, Teresa, one day you're going to have to stop us from raising our own fund. Like, we should just do this as a proof of concept and show that these managers are phenomenal investment opportunities, present phenomenal investment opportunities. And, like, what a silly idea. And Teresa said, hold up. I think that's actually a terrific idea. Let's do it. Let's just the three of us do it. And let's do it as a proof of concept. And let's prove that you can make money investing in these funds and with these managers. So that was actually the impetus. Maybe the three of us are a little impetuous, but we literally decided within a matter of 3 days and had formed our own little tiny fund of funds just as a proof of concept to make those investments. And obviously to write relatively small checks to begin with. But what we found, the more we talked, the more we realized that we would benefit from the counsel and the participation of a couple of other friends with whom we had done DEI work for many years and who were people that we were close to. One of them was Regina Benjamin, who's been a dear friend of many years, the former Surgeon General of the United States, and who had been stepping into venture as an entrepreneur in residence and as an advisor to a number of funds, including First Round Capital, which was founded by Josh Koppelman, another friend. So we talked to Regina about what we were doing. She said that she wanted to be a part of it. She thought it was important. But then when Josh heard about it through Regina, he called up and said, I'm a little offended. Why am I not a part of this? So then he became part of our 5-person founding team. What we found from there is we started to get phone calls, emails, and outreach from folks who had taken those meetings that, the ones I've described earlier, where we were trying to introduce them to really talented fund managers. And they said, I couldn't write that check into Clio Capital or into Ingressive, but how about if I write you a check and you guys can support these managers? I can write a bigger check that way. And you guys can do all the due diligence and do the homework and making sure that the investments are the right investments to make. You have the network and you have the funnel. So that was really how it started. We did not go out and seek to fundraise. The fund kind of came to us, which to us shows that there's tremendous product market fit, which is terrific. People are willing to write the checks, also terrific. One of the things, though, that we decided early on, 2 things that we decided early on. One was that we would not preference warm introductions. So while we do know a lot of folks in venture who are underrepresented managers, we wanted to make sure that we had a true open door policy. So we decided that we were not going to preference warm introductions over funds that came to us via Twitter or via our website or email or an intro from somebody we didn't know. And that's been a terrific decision, in my opinion. We found our way into some really wonderful funds and gotten to know some great fund managers that way. But the other thing that we made a decision to do once we decided we were going to open up our fund to LPs outside of the founding 5 was to make sure that we had an LP base that was representative of the same diversity that we were looking for in our portfolio. So many of our professional and personal connections are people who have not traditionally had exposure to venture capital. They're sophisticated people, they're qualified to invest in venture, but they just haven't had access to private equity as an asset class. So in some cases, those people were intimidated to ask questions. In other cases, they just don't have the network, the right network that would give them access to the deals or to the funds that they might be interested in. So we're really pleased that as we have allowed LPs to invest in our fund of funds, we have a cohort of people that is truly diverse, both racially, ethnically, and in terms of gender. And many of whom, while we do have actually quite a number of Midas listers who have invested through our fund of funds, we also have a cohort of people for whom this is their very first investment in private equity, period, full stop. And we're really pleased that we're introducing them to this asset class. We're demystifying it for them. And we're introducing them to some really terrific managers that maybe they'll want to invest directly in as they get to know them better. And that would be a real win for everybody if that is in fact how it goes.
So to everyone, if you don't have a network, there are funds that don't need you to have a network, and you can just cold inbound. As someone who got her job in venture capital through a cold email, it does happen, and I think you miss out on talent if you are only focusing on your specific network and only one intros. And then the other thing I take away is that in many ways, both you and Lo are entrepreneurs, right? Because to start a fund is to be entrepreneurial, and you had to prototype and serve as an EIR within your bigger company to kind of, figure out the product market fit and then kind of spin out and start. So that was an interesting insight that I got from both of you. So Betsy, you mentioned this idea of not, some funds are very risk averse. They're institutional, right? Because of the amount of money that they manage, they can't necessarily put in smaller checks. But it made me think about how a fund manager investing in underrepresented fund managers actually does the evaluation work. So Jasmine, in your role, what's the process? How do you evaluate? And then I'd love to ask Lo and then Betsy to follow up to see if they have a different perspective on how they do evaluations at their respective funds.
Sure. And so the first part, I think, is so what my role was newly created at Cambridge Associates, and I think part of the rationale is touching on what you've heard from Lo and Betsy, is that I think for better or worse, just as humans, we do still travel in networks. And I think that that's part of the reason why you want to invest in these investors, is because it's not that there isn't a place for white men within venture. It's just that shouldn't be all that we're investing in. If we're looking for a global set of opportunities, we should have investors that represent, those different components and those different populations because of their different life experiences. And what I've taken away is taking that and then trying to apply that to our process. Last year, in the wake of the death of George Floyd and a lot of the social unrest that we've seen in the US and really across the globe over the past year, the top request we got was, okay, well, send me a list of different managers and we'll take those meetings because we want to invest with different people. But my view is that that's insufficient. I think that the harder part of this job is creating an equitable investment process and just as investors, whether you're investing directly in companies or in funds, just as humans, we're built to have mental shortcuts, to look at specific lists to make just our lives and daily survival easier. And so understanding that, what I try to intentionally do is think about what those shortcuts are that we all do as allocators and investors, question those shortcuts and think about ways that they can be more equitable. So as an example, when Betsy is making those recommendations, one of the things that people may not be comfortable with is, hey, I'm not comfortable with a single general partner, or I want a team that has worked together before because that gives me comfort that they'll be together for the next, 10, 12, 14 years, however long this fund life is. And hopefully really what I'm investing for is a firm where I can continue to re-up and invest in 3, 4. So I want to, I think, reasonably be sure that this team is going to stay together. But we're measuring that based off of, have you already worked together? And I would argue what you're trying to measure is cohesion, not their track record. And I think there are tons of other ways that I can measure cohesion. And one of the strategies that I invested in last year is a team that came together around their investment thesis. They had never worked together before, but through reference checks, through meeting and spending time with the team, through speaking to their partners that I just knew socially and was connected through networks, I knew that this was one of the most collaborative, respectful teams that I had ever invested in. But if I was just using that shortcut of, okay, I want a team that has worked together, I wouldn't even look at this fund. And so that's how I think about my investment process, is really deconstructing all of those shortcuts to make sure that we are making equitable investment decisions. You can't use the shortcuts of, I need a track record. I need you to be over this AUM. I need you to have gone to these schools that in my mind, right, like bring prestige or have worked at these firms. I'm much more interested in what you did at those firms and what your actual role was and what you learned and the lessons that you're taking and what you are going to do and not do, again, versus, names on a resume. And that's the harder work. And so to me, I think really part of one of the big barriers that just as humans, right, like we are lazy. We are going to take the path of least resistance. And this is harder work, but I think ultimately is more rewarding. As investors, what we should be doing is continually, whether it's this or anything else, you're trying to find underinvested in opportunities. You're trying to find investments that other people don't see the potential in. And so to me, I don't get the value out of investing in the same names that everyone else is. We wouldn't do that within a portfolio, and we're not going to do that for fund managers. And so I think that this is the work that has to be done.
I love the idea of cohesion. I've never heard that before, so I'm going to steal that from you, but I'll annotate it if I ever use that in a presentation, Jasmine. And the other thing is, best investors aren't framework thinkers, right? They're not checking a box in the way that you described. If you really want to find like those companies that are going to make you the most money, it's doing things that people don't tend to do. So I thought those were really powerful takeaways, Jasmine. I'd love to get your perspective on assessing fund managers, Lo. Maybe share a little bit about your process.
Happy to. So we have a 5-stage process that was architected by our analyst, Sam. And it begins with something that that Betsy mentioned, and I'll give credit. It was Kapor Capital uses, I think, a really good way of kind of providing a level playing field by having everyone fill out the same form of information. So we use Airtable, and even if it's a warm introduction, I've made 2 LP commitments that came in over LinkedIn. So they, I suppose they could have gotten to me, but I somehow saw the message in my thousands of messages and actually made a couple of LP commitments, Boom Capital and Workbench. So we like everyone to fill out the same information on the front end. And then our process starts with looking at the track record. So I think a track record is really important for us in our process. That said, I'd like to think that we are the most flexible institutional investor when it comes to track record. The most obvious is a fund or a partner GP that's raising a fund 2 or fund 3, and we can look at fund 1, fund 2 performance, but we'll also look at the prior firm. If the firm allows attribution, great. If not, we'll work with the GP to piece together their track record and what role they played. Was it sourcing, diligencing, taking the lead for the firm, taking a board seat or observer? And we'll use publicly available information and piece that together with the GP. We'll even look at prolific angel investment track records. Probably the best case of that, 2 cases, Steve Jang, who is at Kindred, and Ade, who is at Base 10 Partners. I mean, they were both prolific angel investors. And then I would say we'll even take a look at GPs that have pieced together SPVs, because it tells us, okay, well, clearly there's an opportunity for them to get allocation. And then it's also somewhat indicative of potential success raising a fund if they can get other investors to invest into this SPV. So track record is important to us. Then we look at the portfolio construction and sourcing strategy. So portfolio construction, super important. We don't adhere to a strict one size fits all. We look at portfolio construction in conjunction with the thesis of the fund, or could be not thesis and opportunistic or network driven. We'll take a look at geography. We kind of take all those things into account when thinking about portfolio construction. We'll also do some qualitative and quantitative assessment of the sourcing channels for the GPs to understand, okay, well, if they've got this thesis to do enterprise, do they have access to a network to provide them with enterprise opportunities? And then we take all of that, and Vishal, our wizard portfolio manager, who's got his master's in financial engineering from Cal, go Bears, he will then use an approach to simulate what we think the returns will look like for the GP in isolation, and then plug that into the overall portfolio construction for all of our LP commitments to see what impact it has on risk reward. But that said, all that's the easy stuff. That's quick, right? Where we really want to drill in is to understand how the GP is positioning themselves to make their firm different. I think GPs walk in the door thinking, oh, I'm different because I've got, LPs that are CEOs of tech companies, or, I've built a community. And like, okay, well, that's actually not unique. At this point, those types of things are table stakes. So we're really looking to see what is different. And your point, I think, about being an entrepreneur is spot on in terms of how we think about GPs. We want to see the fact that the GPs are very mindful of how their position is within the overall perceptual landscape through the lens of the entrepreneur that they're going to try and win, right? We focus on GPs that lead, so they got to go win the deals. And what is it that the entrepreneur sees from the GP that tells them, wow, they're going to, this is going to make a difference, right? In terms of the inflection points of my company. And at the earliest stages, what do entrepreneurs care about? They care about having the employees to build the product, customers to buy the product, and investors to finance those activities. So we want to understand how the GP is world-class in at least 2 out of those 3 and pretty darn good at the third. So those are the things that are really important. And then we like to take a little bit of a longer term approach and really getting to know the GP. Is this someone that we would like working with as we look towards building a multi-decade relationship, right? I mean, because that's what these are. And I, really need to like those people and make sure that the values are aligned, well. Look, like I mentioned before, we track over 1,100 firms. We've touched over 400 at this point. So clearly there are a lot of firms that we've seen that actually would meet most of the criteria, including great people. But at the end of the day, we're not able to, we've got a very mindful and deliberate and disciplined portfolio construction strategy for ourselves. So I always tell GPs, it just might not be a fit just kind of based on how we're running the math on our own portfolio construction. It has no indication as to whether or not your firm current fund will be successful. In fact, I always say, I want Plexo Capital saying yes as an LP to be positive signal. I never want Plexo Capital saying no to be negative signal.
First of all, thank you for that level of transparency. The fact that you're like, these are the 5 steps. I think all too often you don't have LPs saying that or giving that level of transparency. So whoever Sam is, we love Sam. Process. We got to.
Yeah, and look, we lay out the process and kind of what we look for and what the target number of LP slots are, how many slots we have left. We lay all of that out on the front end in the intro email when we have the link to the Airtable. And at each step of the process, each stage, we let the entrepreneur know, or excuse me, well, think about them as entrepreneurs. We let the GP know exactly where they are in the process. I think transparency is one of our core values, and we like to think that we're as transparent as possible with our process.
Yeah, because I will say a lot of feedback, also having been at my old fund doing directs, but a little bit of LP, investing, is the more you are transparent, people know what the process is. And yes, you can take rejection. I think rejection is just hard not to take personally, but sometimes just knowing that you're going through the process and moving forward makes a significant difference. So Betsy, would love to hear a little bit more about your evaluation of fund managers. I'm sure you probably echo a few things that both Jasmine and Lo said, but anything that might also differentiate your process?
So I was nodding my head so vigorously as Lo was talking because, unsurprisingly, I agreed with every single thing he said. And a lot of what he described is exactly the same process that we follow. So it all makes a ton of sense to me. And I suspect the 2 things that I'm going to add here are things that Lo either subscribes to or does, and I'm sure Jasmine as well. But nonetheless, I think they're worth just highlighting for a moment. One is that a lot of institutional LPs look for a certain GP commit as a percentage of the fund. And I apologize, there's a leaf blower in the background here. I don't know if you guys can pick it up. We do not. We think that mandating a certain GP commit is yet another institutional barrier that underrepresented founders have to jump over. It presupposes familial wealth or access to capital that not everyone has. So that's really not something we care about at all. We think there are lots of ways that founders can show us, or founding managers can show us that they're in alignment with us and their fund. The other thing that we look for that we think is critical for a fund's long-term success is the ways in which a fund manager is planning on or has already demonstrated that they can be helpful and supportive of their founders. Especially crucial in how they're going to help them get a next round of funding, which at seed stage is particularly critical. So all the things that Low looks for, we look for as well. We also believe that we should be applying a rubric even-handedly across all the funds that come through our door, and we try to look at everyone, across an even playing field to help us debias. But in addition, as I say, I suspect that Low does this as well. We really don't care about what your GP commit is, and we do want to see what your plans are for supporting your founders and also, frankly, the larger community in which you operate. Like we also look at all this as a multi-decade relationship. We want to be in business with people that we respect, admire, think are good people, and who are additive to the venture community generally and who are generous with their support of others.
So what I thought was interesting about this is this idea of relationship building. So since, Lo, you mentioned Base 10, I had a conversation with Adeyemi once, and I was telling him, what's the difference? You've been an entrepreneur investing in raising for your company, and then you've also been almost entrepreneurial raising for your own fund. And he's like, Carolina, in Spanish, he said to me, he's like, the big difference is that one is like being an SDR, sales development representative, and the other is being enterprise sales. And raising for a fund is like enterprise sales because it is a long game, right? And I think sometimes for all of those GPs who are raising, this is not something that you're gonna get, especially for people that are, I would say, like investors here, this is not like a 2-day turnaround decision, right? Because as Lo pointed out, you're investing in a franchise, right? You're not just investing in like fund 1 or fund 2, but like 30 years out in this fund manager that you're going to invest in. So I think it's really important to have that level of context. So going to Jasmine, something that you and I have talked a lot about is LPs now are asking for survey data on underrepresented fund managers or even underrepresented founders in the portfolio. So I know Cambridge has done a lot of research and they're also global. I'd love to get your context on how do you do those surveys? Because like I was talking to a nonprofit and they're like, hey, we want to send out this survey into this part of the world. And I took a step back because I said, some of the questions that you have on gender or even disability might culturally not make sense for that region, right? Like there's some things that are taboo in that region. So
exactly,
think about that.
So since 2019, we have been surveying our fund managers that we invest in, both for underrepresented founders and non, so across our entire portfolio. And we've been doing that not only seeking ownership, which is commonly how diverse managers are defined, but we wanted to start gathering in-depth data. And so we look at 3 additional layers. So not only who owns the firm or who, how the economics are distributed, but also what is the composition of the management team of the firm? What is the composition of the portfolio of managers of an individual strategy? Like who's making the decisions on that strategy? And then what does the entire investment team look like? And the reason that we did that is first because I think fundamentally I don't believe that it is on the shoulders of women and people of color to change the complexion of this industry. Right? Like we have to have everyone involved. And so what we currently can easily identify is who are the diverse managers. But what I wanted to know is where's the rest of the diversity in the industry? Because ultimately, as investors, we need to predict what a firm looks like going forward, right? So we need to measure not just the bathtub, right, but the temperature of the water coming into the bathtub. And so what we're hoping is that we can see those junior levels, what the composition looks like, and we want to track that over time, right? Like we also want to be able to hold our fund managers accountable. So if you came to us and on this fundraise said, hey, we went out and recruited the best and the brightest, diverse talent, across the globe, and we brought them all in as principals. When you come back to that next fundraise, okay, well, have those people stayed at the firm? Are they clear on their path to promotion? Have some of those moved up? Or, right, like is some of this theater and you're just kind of padding the numbers? And so we wanted to be able to have grounding, to have those compositions. But to your point, as a global firm, we had to ask those questions in a global context. And so the way that we did that was breaking the world into regions of where our fund managers were, developing definitions that were relevant to those regions, but then also, again, trying to check our own biases. I partnered with our colleagues in those different offices. And when we came up with those answers, I sent it to our colleagues and said, hey, does this intuitively feel correct to you? They're on the ground. They have more experience there. And even in those initial drafts, some of the terms people felt like, oh, this doesn't make sense. I wouldn't say this. People wouldn't be comfortable with this term. And so you have to respect the communities that you're operating in and bringing that context. Something that we're thinking about now, and some of our clients have started to ask us about, are those distinctions between race and ethnicity, particularly within Latino populations, right? So traditionally in the US, we have focused on Hispanic populations, but there is obviously a difference between someone born in Spain and underrepresented people of color, right? Like from indigenous populations in Latin countries. And how do we ask questions that make that distinction? In the US, some clients are focusing on building their IPS in Latino rather than for Latino populations versus Hispanic. But what does that look like in Peru? How do we contextualize those definitions? And I think we have to be very thoughtful about the definitions that we're asking, because there are some universal diversifiers, but there are some that are not. So that's what we're working on.
Yeah, so I think there's not a one size fits all. And I think it's really powerful that you leverage, because you're a global fund, you are able to leverage people in the region who can inform surveys. So I thought that was a really, really powerful takeaway, leveraging the resources that you have. So one quick poll question for the group. How many have you, with a raise of hands, how many have you invested in solo GPs? Thank you, hands down. Used to be a fourth grade teacher once in my lifetime, so I appreciate the class participation. I think that's really, really important to note, because there is a conversation now in the US around the solo capitalists or the solo GP. So I wanna just get very quick sound bites from each one of you on why, because to the point, like, what if, I've always heard from maybe some more institutional LPs, that's really difficult to do. What if they get hit by a truck? How is that fund going to live on? There's just a lot of negative feedback on that. So would love to just get your quick take, Jasmine, on why you felt comfortable in investing in maybe even a first-time manager who was a Black solo woman, right? So,
I mean, the real answer is they were awesome at what they were doing, right? So they were good. What I will say is the pushback that we got from some of our clients and colleagues is not so much the hit by a bus factor, but the scale. So for us, as Betsy said, we're looking for a relationship that we can invest in over decades. And even if a fund is small now, what we're hoping is we can scale that over time. And what we thought about as a limiting factor was the capacity. So if you are a solo GP, I think there are limits on the size of that fund just because of the amount of time that you can devote, especially if you're an early stage investor where those relationships are more time intensive. And so if I was a solo GP, what I would think about is how are you answering, what does your strategy look like at scale? And then think about who are the appropriate investors. And so for us, this is a better fit with some of our smaller foundation clients, but for a large pension that's looking to write $50 million checks, maybe that's not the best fit.
Got it. And then Betsy and then Lo would love your opinion. And then I'll have one more question for everybody.
Sure. So yeah, I mean, I don't really get it personally, why anyone would have a bias against solo founders as opposed to duos or triads, because the fact of the matter is it can be just as problematic if there's a problem that crops up between two founders. And in terms of the hit by a bus argument, by and large, if it's a good founding team, they have complementary skill sets. So if one of them gets hit by a bus, by and large, the other one isn't going to have all the skills that would be required to run the fund solo anyway. So it seems to me that you're not really mitigating your risk by preferencing non-solo founders. In terms of scalability, I totally agree with Jasmine that it can be a rough go to be a solo founder, especially if you've got a large portfolio of companies. We do have some funds that we've invested in, like Blossom Capital in the UK, where the founder, Ophelia, has highly concentrated positions in the portfolio companies that she backs. And some would say, well, that's awfully risky. You better hope that some of those are winners. But the fact of the matter is, if she's doing her job well, if she's diligencing well, and she has real conviction in the companies that she's investing in, there should be some winners there. And her Fund One, as it turns out, has done remarkably well, best in class in Europe, actually. So, I think that's, as Jasmine mentioned earlier, that's a great example of a bias that institutional investors and individual LPs bring with them that I'm not really sure is rooted in data or in actual experience so much as in our own biases and preconceptions.
Got it. And Lo?
I think I don't have much more to add because I think Jasmine and Betsy pretty much nailed it. I'll just try to throw in a few additional thoughts. I always think about the dissolution of a partnership as being more challenging and problematic than a marriage in many instances. And the thing that I always say is, well, I mean, a solo GP won't divorce themselves unless if there's other issues going on that you have to worry about. So I'm totally for solo GPs. Charles Hudson, I think, has written the most on this topic. And the thing that Charles and I talked about early on was Charles said, look, just, if someone's not comfortable with it, I don't try to change their mind. And it reminds me of the old adage, spend more time with the people that love you as opposed to trying to convince those that don't to love you. That's how I think about it.
I love that. So because we're at the Peruvian Venture Capital Conference and in Latin America, a lot of people are trying to catalyze funds by having the government start their own fund of funds. If you had one piece of advice to give those folks on how to catalyze the ecosystem, but also to make it more inclusive, I know that's a lot to share, but if you had a one-liner, what would it be? And we'll start with Betsy first, and then Lo and Jasmine.
If I can only pick one, it would be write small checks. It really isn't that much more of a hassle to write a small check than it is to write a big one. And given all of the technology that we have to help us manage our portfolios these days, you just feed it into whatever model you're using or whatever software you're using to manage your portfolio. So you have a few more positions. It's not a big deal. And it truly does diversify and amplify the ecosystem in ways that big checks don't.
All right. So write small checks from Betsy. Lo?
No geographic constraints. I think one of the things that I've experienced and actually killed a deal is that the business bank that was the LP wanted to place geographic constraints on the GP. And I think given the nature of Latin America, as a former product manager, one of the best markets we had was Latin America. I love Latin America because it was so easy to localize. And I think even though there are unique cultures, obviously, across the many different countries and regions, nonetheless, there are a lot of shared similarities that I think provide the opportunity, unlike other regions to really excel and roll out products across the entire continent quickly. So I think just kind of given the fluidity of the nature of our industry, as well as the commonality that a lot is shared, obviously language for the most part, no geographic constraints.
Got it. And Jasmine, last but not least, you're closing us out.
Thank you. In my former life before Cambridge, I worked with managing emerging manager portfolios for several of the state pensions here in the U.S. And so I got to see how those were successful in some of the areas that they ran into issues. And what I would say is start with figuring out what success looks like and use that to inform how you construct the program. So what I saw was that within the US, we would set up these artificial barriers that really undercut what the intention was, right? So if our intention, again, to Betsy's point, is to catalyze capital and invest in early stage founders, then putting minimums on the fund size because of the ideal check size completely puts you in a different set. If your idea, focus on what populations are you trying to impact, right? Like, and say, okay, how do we intentionally access that? And that's going to inform our sourcing strategy. So start with what you want, what success looks like for this program, and use that to inform the strategy would be my advice.
Got it. Well, first, I just want to close out with saying thank you so much. It means a great deal for you all to spend time with the Peruvian venture capital community and at large I know people from Europe as well as different parts of regions are also watching. So I want to say a huge thank you. And I want to close out with some key themes. You can prototype a fund. Single GPs are okay. And when you're thinking about, if you're a government trying to catalyze an ecosystem, think about what success looks like, write small checks. I also want to say, get yourself a SAM, because SAM is now, in terms of like the transparency, you need a SAM to actually have the transparency of what you actually want to invest in, and do not have geographical constraints. So thank you again. Gracias, muchas gracias para todo, y que viva Perú. Thank you so much. Bye-bye.
Thanks for having us.